Hello, everybody. Welcome back to my YouTube channel and back to the podcast. Today, once again, we have a very special guest. Denise Pisani is here. She's a very well-known mortgage broker here in the city of Mississauga, and she's with two different companies. Let me make sure I get this right, Denise. Mortgage Center Canada.
It's one company, Mortgage Center Canada.
Mortgage Center Canada and Mortgage in the City. Okay.
Is my company.
Is your company. Okay. So welcome back. We've done a few of these, but we haven't done one for a couple of months now. So it's great to see you again. I can't believe it's September. The kids are back to school. Summer's over. And man,
back to a routine.
What an eventful year it has turned out to be in real estate.
It really has been. From the last time we got together.
Yeah.
Craziness.
Yeah. Well, we knew rates were going up. And everybody said at the beginning of the year, you know, this boom market back in January, February was not sustainable. It was crazy stuff, as I'm sure you remember, with huge multiple offers on every listing and prices were going through the roof. And everybody was saying, we have to do something. This can't last. But then what's very interesting is the Bank of Canada, they didn't really seem to care too much about the real estate market. They just let it explode over the last couple of years. But once inflation started to pick up, when people were seeing increases in prices at the grocery store and when you're filling your car up with gas, that kind of thing, all of a sudden it became a hot topic with the Bank of Canada. So since the beginning of the year, we've had several rate increases. I believe the total, and the last one was just September the 7th, just a couple of weeks ago or 1 week ago. And I think we're up now where they've actually raised rates a full 3% since January, because I believe at the beginning of the year, it was just 0.25% was their overnight rate. And now we're up to 3.25%, which is huge increase. So the market has definitely slowed down. I know I watch it on a daily basis. And over the last several months now, we're down year over year in terms of sales numbers, about 40% year over year. I think the August numbers just came out. I think it was roughly 40% down in activity. Prices have fallen, but it's kind of spotty. Like certain prices have fallen. Houses, I think, have taken a bigger hit than condos.
Right.
And some areas, like in the east end of the GTA, I know they've had huge price decreases of up to 20%. Other areas, not so much. And it's a weird market because I have friends in the industry and stuff is selling. It's selling as long as it's priced correctly. And there seems to be, there's been some issues with closings, but the vast majority of them are closing okay. And so we're in a weird market. I just talked to somebody yesterday who put a coming soon sign on a lawn in Sheridan Homelands in Mississauga like 3 days ago. And he's already had 3 calls on that coming soon.
Yeah.
Which is not, to me, that's not indicative of a market crash. There's something weird going on. It's just, there's so much demand. And of course, we've got historic shortages of housing. We've got labor shortages in the job market where nobody can find enough employees to hire. And we've got huge immigration coming in. Now we've got Ukrainian refugees coming into Canada, which I think it's building like a buffer, where there's so many people moving here that the prices can only go down so far. The rental market, as I'm sure you're aware, is on fire, where there's multiple offers.
There's multiple offers
on rentals.
Rentals, yeah.
It's crazy. And in the backdrop of all that is in your area of expertise. Again, rates are up. I get your newsletter. Thank you very much. It's a wonderful newsletter. And just the other day, you sent it out where I believe we're looking at around 4.5% now. Give or take, for a fixed rate 5-year mortgage, and that's
only high ratio, Randy,
which we're going to talk about.
Yes,
and also the variable rate is almost the same. It's about 4.5%, give or take. So I'm going to turn it over to you because that's again a very unusual thing when variable rates are pretty much the same as fixed rates, and obviously it's
happened before, like years and years ago, but
okay.
Yeah, but we're getting to that point now where they're hovering around the same.
Yeah.
So if you're a first time buyer or second time buyer, but putting less than 20% down,
right,
and you want to lock into a 5-year fixed term, you're looking at a rate around 4.59. So 4.59 to lock in for 5 years, which is still relatively pretty good.
Exactly.
Yeah, and if you wanted to, take a chance on a variable, in a purchase of a high ratio mortgage, so less than 20% down, you're looking at about 4.55. So bank lending prime right now is 5.45%.
Okay.
And then the discount on a high ratio variable mortgage is $690 off. So almost 1% off.
Oh, interesting.
A full point.
Interesting.
And that is on a high ratio mortgage. But if, on the other hand, you've got equity and you've got 20% to put down,
right,
believe it or not, the rates are higher. I get a lot of people, it's very confusing.
I don't get it. To me, that's a safer, from the bank's point of view, that's safer because there's a bigger down payment.
Well, it is safer, but on the other hand, the banks are safe as well if the mortgage is insured, because CMHC or Sagen, formerly Genworth Canada, is insuring the mortgage. So the banks are protected even more. So that's why they're getting a little bit of a better rate. Plus, the people putting less than 20% down are paying a huge insurance fee. Yes. And the government said, hey, because you're paying $20,000 in fees, we're going to give you a little bit of a break on the rate.
Okay.
So going back to people putting down 20% or more, the rates are slightly higher. And you're looking at around, we can probably get you 5.19 to 5.35 roughly in that range for a 5-year close. So definitely over 5%.
Okay.
Looking at about 5.25.
So again, this is kind of an upside down world. So if you have more than 20% to put down, you're looking at north of 5% for your mortgage.
Exactly. Rate. And if you want a variable, it's roughly around the same. You're looking 5.25 to 5.35 for a variable.
That is so interesting.
Yeah.
That is so interesting.
Yeah.
So that's a very unusual situation. So basically, people that have lots of money to put down are kind of being penalized in a way where they're paying over 5%, and people with less than 20%, because there is a form of insurance that they have to purchase with CMHC or whoever.
It works out to almost the same when you add that the fee for the premium. It really does. Like they're paying $20,000. Usually between $15,000 and $20,000 in an insurance fee that's added onto the mortgage.
That's right.
So on closing, they actually add, they have an additional $15,000 to $20,000 owing on the mortgage. Right. So if you really calculate it over the years, it works out to be the same payment, really.
Okay. Let's talk. That's very interesting.
Same interest rate. Sorry.
Right. Let's talk a little bit about the stress test, because this has always been a hot topic over the last couple of years. The stress test, for any listeners who may not be aware, is a test that basically buyers would have to pre-qualify or qualify at a higher rate of interest than what their actual contract rate of interest is.
Correct.
As kind of a buffer, so that in the event that interest rates went up, they will be pre-qualified, and the banks will be more comfortable that they would be able to handle any increase in monthly fees. So the stress test, when it came out, was 5.25%. This is back when mortgages.
It actually was lower. It was it was in the fours, in the low fours.
This is why I've got you on here, Denise.
Yeah.
That's great. So anyways, but the whole point was they would qualify at a higher rate. And then the good news, they would get their actual mortgage, which would be at a lesser rate. And then everything was fine.
Yeah, we've stressed everybody. We've stress tested everybody that owns a house right now in the last 5 years. So people are panicking that the rates increased.
Right.
But we actually stress test them at today's rates.
That's right.
So they should be able to handle the payments.
Okay. So for people who are perhaps a first-time buyer who are not too familiar with this, now that actual interest rates are hovering around that 5% mark, and the stress test went from 4.25% up to 5.25%. How does that work now? My understanding is there's some further complications.
It's plus 2% of their contract rate. Okay. So if their contract rate in a high ratio mortgage that we just discussed is 4.59,
right,
then we would stress test them at 6.59.
Got it.
So it's the contract rate plus 2.
Okay.
So this person purchasing, let's just say a first-time buyer,
right,
and they're locking in for a 5-year rate at 4.59.
Right.
We would stress test them at 6.59 to make sure that they can handle those payments at 6.59.
Okay, perfect. And that's for, excuse me, that's for both fixed and variable mortgages. Doesn't matter.
Variable, we would take the variable rate.
Right.
So in this case, it would be 4.55.
Right.
And we would stress test them at 6.55.
Got it.
Right.
So everybody understands that. So you're going to be basically stress tested at around 6.5% up to 7%.
Correct.
Right.
Well, more for someone putting down 20%.
Got it.
So their rate is roughly, like we discussed, 5.25. So we would stress test them at 7.25.
Got it.
So these people purchasing a property we need to ensure that they qualify to carry payments if the rates went to 7.25.
Right. So anyways, and again, you're the expert on this because I know you do it every single day. In terms of purchasing power for an average, let's say a first-time buyer, a young couple that want to buy a condo for the first time, condo prices have gone down a little bit, but not that much. And so you're looking at maybe $550 for a condo these days, $600 maybe for a nice one. How much household income do you think a person would have to have in order to? I realize there's variables, but for a stress test at roughly 7%, what are we looking at?
We're looking at 4.5 times their income.
4.5. Okay, so that's changed a little too.
So so between 4.5 and 5 times their income. So if you get a young couple coming in and they make 100,000 together,
right,
multiply that by 5, and you're looking at, they qualify for a 500,000 purchase.
Right, that's the loan
mortgage.
Amount. Loan amount. Right. So anything above that would be their down payment, and
that's very rough, because if they've got leases and student loans and car loans and credit cards,
got it.
That all plays a fact in qualifying as well. So this is just a rule of thumb.
Okay.
Yeah. So you could just say, if that young couple's looking for an $800,000 home, townhouse or condo,
right,
it's not happening
unless they got
if they're
huge down payment.
Them is 100. So it's just, but if you're close and you're saying, they're thinking, we're looking for 500, 550, it's worth a shot. Let's work out the numbers and see what we can come up with.
Got it. Such a funny market. It's definitely not a crash. Definitely not. Even though the numbers are down, there seems to be no urgency for buyers or sellers. I think a lot of sellers have kind of stepped back a little bit, just waiting to see what's going to happen. And a lot of sellers, they're saying, you know what, let's hold off. Yes, the rates have gone up, but I follow a few people on Twitter and some industry types. A lot of them are saying that this might be the last increase, or there may be one more before the end of the year. But who knows? I'm not predicting.
I've heard, and I heard just yesterday, I spoke to a colleague that works at Scotiabank.
Yep.
And she recently had a market outlook, an economist come out and do a market outlook for 2023-24.
Yes.
And I'm actually hosting one on October 12th. Everybody is welcome. So where can people? Well, they can follow me on my Instagram page. Okay. My handle is Mortgage in the City.
Got it.
And I'm going to be sending out a registration. And if you want to come, join in on the Zoom, it's going to be through Zoom on October 12th.
I'll be there
at 11 a.m.
Okay.
And I have one of the best economists in Canada coming out, and he's going to update us and let us know about what he thinks and feels is going to be happening in the next year and a half.
Okay. What was the date in October again? What was
October 12th at 11 a.m. Yeah.
Okay. I'll put that information underneath here on YouTube and also on the podcast.
Yeah. So basically, what I've heard, that rates are probably going to be going up another 1%.
Aye.
Yes. Okay. So October 12th, October, we're looking for at the next meeting. And then there's another one in December.
Oh.
I heard through one source that we're just going up in October, and then that's it for the year.
Okay.
But then another source, I heard that we're going up both times, and then hopefully mid 2023, end of 2023, we'll see a drop starting to come again. But who knows? I'm hearing different.
That tells me that nobody really knows. Even
knows.
The experts, even these high up economists with the banks, and probably the president of the banks and the Bank of Canada probably doesn't even know exactly.
Exactly. Yeah.
So yeah, it's an interesting time. And again, I go back to what I said at the very beginning. We're not into any kind of panic selling at all. In fact, listings are way down.
No, everyone that I've spoken to, like I'm telling you, Randy, I've probably had 50 files on my desk with buyers in the last year. And a lot of them, I'm probably down to 10. A lot of them just want to hold off. They want the increase in rates have scared them.
Yep.
But how things have come down. So it's not a bad thing either. Like, houses have come down if they've come down 100,000 or 200,000 and rates have gone up, your payments, believe it or not, are actually lower. with the homes decreasing.
Isn't
so
that
you
interesting?
really need to talk about what's going on. Don't just ignore it to the fact that the rates have gone up and I don't want to buy.
Yeah.
Because the payments have actually come down in some cases. So
unbelievable.
Yeah, good to look into it and see where you stand. Definitely don't put it on the back burner. Try to get your file updated.
Right.
I really encourage that. If you were thinking about purchasing, don't ignore it completely. Let's get on the phones. Let's figure out your numbers. And if it doesn't work for you, then put it on hold for a little bit. Yeah.
There could very well be some bargains out there right now. I think as long as you feel that your job is pretty secure. Right. And again, I look around, and we may have talked about this last time we had a session. Everywhere I go, there's help wanted signs everywhere.
Yeah.
Factories, warehouses.
Let's face it, Randy, we need to hunker down on our spending. Like, maybe not have Netflix, Disney, Rogers, and all other sources of entertainment available. Cut it back a little bit. Call your Rogers and see whether you can scale back on some things. Call Bell and see if you can scale back. A little bit of money here and there, savings. I would rather do that and own a property than have everything under the sun available to me, right? So
I agree.
Yeah, so people definitely have to scale back a little bit. Like, I think, we were all home during COVID, and we were saving lots of money. And then when things opened up, we just started spending.
A lot of people
now rates have gone up, variable mortgages have gone up, their payments. Yep. So people need to sit down and look at their finances and make sure that they're not spending, just on anything, right?
I agree. 100%.
Yeah, exactly.
I think a lot of people are in that mode right now where they're, instead of going out twice a week, they might go for dinner. They might go once a week or twice a month. Maybe.
Exactly. And you know what, Randy,
not a bad thing.
Next session, we need to talk about the trigger rate. I know we've talked about that.
I'll just give a preview for the next, we'll do that next session for sure.
Yeah, because I just found some big stats out on triggers. Banks, for example, TD Bank is ready to send 250,000 letters out to clients regarding their trigger rate. So
let's give a little teaser. Let's give a little teaser to the listeners today. A trigger rate is with a variable rate mortgage. First of all, there's two kinds of variable rate mortgages, which I'm sure you can explain better than I ever could. But one of them has a fixed payment. One of them does not. So the one without a fixed payment is easy to understand. I believe that's with Scotiabank. So when rates go up, the payment goes up. But with the other banks, it's a fixed payment. And what changes when rates go up is the ratio between, on your payment, the ratio between the principal that you're paying and the interest that you're paying. So in theory, what happens is as the interest rates go up, the interest portion of that payment grows and grows. But then you get to a point, which we're calling the trigger rate, or the banks are calling a trigger rate, where all you're paying is interest. And at that point, apparently, this is something I was not aware of, even as a veteran of the industry. Within those fixed payment variable rate mortgages, the banks have the right to increase your payment. And it's not a huge increase. It could be $100, a couple $100 to make sure that you're still going to pay that off within the amortization period. That's my understanding.
Right.
But this is a hot topic right now.
It is. Yeah. You know what? It's like, I'll confess to as well. I did work at the bank for 20 years, and we never spoke about a trigger rate. We've never been in an environment where rates have doubled so quickly. Right. And it's caused a lot of chaos in the industry because we were not, we knew about a trigger rate, but never would we think we would get there. And it happened so quickly that...
Well, if TD sends out all those letters, you and I better have another talk very soon, because there's going to be a lot of people.
There's Royal, there's CIBC.
Yeah. Everybody except Scotia, I think.
Yeah, Scotia does not. And then there's the monoline lenders like your MCAPs, your First Nationals, your Home Trust. They all have an adjustable mortgage variable rate. So,
but what I've heard, we don't want to scare people on this call today. The increase that we're talking about here is $100 or a couple $100, depending on the amount of the mortgage. It all depends
on the size of the mortgage. Don't forget, Randy, people were purchasing $1.5 million homes, $1 million townhomes only 2 years ago and taking a variable at 2%.
I know.
So that might be a $500-600 increase. So it all depends on the mortgage.
We're living in interesting times. That's for sure.
We are, but definitely we'll get back on a call with respect to the trigger rate.
I appreciate that. So listen, always a pleasure talking to you, always. And it's nice to see you back. And I know both of us had busy summers, but there's going to be a lot to talk about, I think, in the coming weeks and months. We're definitely going through a very interesting time. And I think a lot of people keep an eye on that market, because there are already bargains out there, I believe.
Yeah, for sure. And owning is definitely better than renting.
I can get out the charts.
Yeah.
You keep renting, you're going nowhere. You own something, and over the long term, yes, like any market, whether it's a stock market or whatever, any kind of market has ups and downs. And we're in kind of a little bit of a down period, but I don't think it's anywhere quite the serious situation that some people out there, especially on social media, are saying it might be. And again, I've got all this anecdotal evidence from other realtors and from my own experience that, there's still a lot of activity going on out there, as long as sellers realize that it's no longer January. It's September and prices are different. Price it right. There is a buyer out there for your house or condo, for sure.
Exactly.
Denise, thank you so much. And I'm going to look forward to your presentation coming up in October. That's going to be fantastic with Scotiabank. Definitely.
Yeah.
I urge.
No, not with Scotiabank. It's with Sagen.
Oh, it's with Sagen.
Yeah. Generally, formally Genworth Canada. So it's one of the insurers, the economist with one of the insurers.
Okay.
Great
perfect.
Casey.
That's perfect. And we'll definitely get that information out there for you. No problem.
Yeah. Awesome.
So listen, thanks again. I know you're super busy. Have a wonderful day.
You too. Take care.
We'll
Thank you.
See you again soon. Take care.
Thanks, Randy.